Well, this is a heck of a story. The once awful housing market, now the bright spot in all the market turmoil. New home sales rose 5% last month. Median price of a new home at the highest level since September 2008. Existing home sales hitting 8-year highs. So is this a sign that the housing market really truly is a bright spot and it is recovering and it'll keep us out of recession? Joining us now, I'm so excited, Liz Macdonald, columnist for the Fiscal Times, and John Lonski, chief economist for Moody's Capital Markets. Let's take it to you, Liz. What do you think?
Well, look, there's been some recovery for sure. It's been a long time in coming, and gradually we've gotten rid of the overhang of properties that were out there with owners underwater and so forth. Look, I think this turmoil in the market could create some problems for the housing market. On the one hand, the good news would be if they put off raising interest rates. Obviously, that'll have an impact on mortgage borrowers. Rates won't go up. But it's kind of slammed self-confidence and consumer confidence, and that's really been at the heart of the recovery in housing.
Yeah, that's a good point.
Yeah, I think you're right to an extent, but let's not forget that this housing recovery looks very weak from a historical perspective.
Okay.
You know, in the land of the blind, the one-eyed man is king, and that's where the housing market is today relative to the overall economy. So we look at today's number at housing starts. I think it's 500.
You really think the entire economy is blind?
Yes, I think this is the worst economic recovery since the 1940s. So I'm using a metaphor here. I'm saying that it's
I hear what you're saying.
But what I want to point out is that for the month of July, the annualized sales rate for new home sales was 507,000 units.
Right.
And that's some 37% under what it averaged during 1993, 1999, which is well before the housing bubble.
You really had to burst my little housing bubble.
I'm
totally kidding.
And I think Liz made a good point about the importance of consumer confidence. If we're going to have lower equity prices, what we need to offset any loss of confidence to lower equity prices, significantly lower Treasury bond yields. That didn't happen today. For some strange reason, the Treasury bond market thought all is well with the world, and the 10-year Treasury yield moved up towards 2.10%. I would say, given current...
But that's good for mortgage rates, though, still, right?
Well, that's still relatively low, but we have to have even lower mortgage yields to offset the loss of confidence.
I see what you're saying, to make the housing market really pop.
This is what happened in 19... So we have to have the 10-year Treasury yield move down towards, say, 1.75% to make up for the damage done to household wealth and to confidence by lower share prices. And by the way, historically, what we tend to find is that deep slides by equity prices tend to be followed by a softening of home prices, and that's something we don't need when we still have about 15% of mortgages underwater.
Still underwater. Go ahead, Liz.
Keep in mind some of the strength in the housing markets at the high end. So those are the people who are getting battered right now in the stock market. So that's so
what does that mean? What's the fallout of that?
Well, I think people who are not feeling the wealth impact means that you're not sitting there saying, oh gosh, it's time to trade up in a better house. You know, housing prices have gone up, and again, the real strength is in the high end of the market. It's also the fact, though, that rents have been going up. You know, when you have a giant cycle, as we had in housing, and people basically stop building for a period of time, which is what happened, you know, there's a shortage now of rental houses. So people are assessing the difference between renting in a new market or buying a house.
You agree with that, John?
I want to add something else, though. You know, in the New York housing market, among the big buyers of luxury apartments and housing in the suburbs have been the Chinese. Likewise for California.
That's a good point.
Emerging market buyers have been very big here. Brazil, from other countries in Latin America. But wait,
aren't the rich guys from China leaving now? And they could still be buying here.
Well, I wonder if they're going to just, you know, there are probably fewer rich people in China today, given the way that equity market has taken a beating. And that might
only 1 in 30, something like 1 in 30, 1 in 15
that might expose
people. Only 1 in 30, 1 in 15 people in China actually invest in the market, though, right?
And almost all
those are going to be
gotten
people with the money, right? Those are the ones, and those are the ones perhaps that have been buying real estate here in Manhattan. So we could be in for some nasty surprises as far as the durability of home prices.
Well, we're going to watch that. Thank you, you two. So good to see you. Thanks for joining us.